Chapter 7 of the Investment Funds in Canada course. This describes the types of investment products and how they are traded. After passing the IFIC exam, you will be licensed as a mutual fund representative. You can only give advice on mutual funds. However, you do need to understand about the different types of investment products because a client may bring a statement to you and you need to know the basic concepts about those investments. But you cannot give advice about stocks or bonds or other items which you are not licensed for. So in this, we will first talk about fixed income products. Fixed income products are most common types are government and corporate bonds. So bonds are issued by government or by companies. GICs, guaranteed investment certificates, are mainly issued by banks. Treasury bills are issued by government also, and then bankers and commercial papers are obviously issued by the banks. So these are, think of them as the option to invest in these bonds give you a guaranteed return and a guarantee that you will get your money back at a future date. So that's why they're called fixed income securities. So by leverage, we mean that the company is actually leveraging the corporation that issues a bond, they forecast a larger return on cash invested in their venture than it would cost to borrow money. They can boost the inflow of the company by sourcing out the funds. So for a company, it is a debt, the company which issues the bond, because they are borrowing money from the investors and using the money in their business. If the company is giving, suppose, 2% interest or return on them, on the bonds, the company is probably expecting a higher return from that money in their business than the interest they're paying on it. So it is leveraging for the company or for the government that issues the bonds. And bonds can only be purchased in certain denominations, and most typically they are like $1,000. Let's take a look at this example here. Basic fixed income products. Let's look, this is a regular bond. Let's suppose an investor has $10,000 to invest. So they go to the bank or a company or the government and they say, I have $10,000. I'll loan it to you for, say, 5 years. So the company or the bank or the government will say, that's fine. Give us the money and we will give you 3.5%. For example, it's called coupon rate, interest payment. So what is 3.5% of $10,000? That is $350. So the bank is going to pay this person $350 the first year, $350 second year, $350 third year, fourth and fifth, so on. So the company or the government gets to use the $10,000 in their activities for that 5 years. There will be a document called the bond trust deed. It tells how long the bond is for, the coupon payments, the annual interest, any item pledged, and if company can cancel before maturity, and other information. So after the 5 years is up, the client will get back the full $10,000. This is known as the principal or the face amount or the par value. By 100 par, we mean that 100% of the value or equal amount is returned to the client. And that is the last, of course, year. In the 5th year, they're going to get their final $350 payment, plus they will get back their $10,000. So this is the way the regular bond works. So we were saying that the denominations are $1,000 or $10,000, and after being issued, they're sold and bought between investors in the secondary market. So they can be traded at a premium that is over 100 or at a discount below 100. So they may be getting bonds at a cheaper price or at a more expensive price. So as we mentioned, there are government bonds which are issued by the government of Canada and provincial and also municipal level. So they can have short-term, long-term maturity, and there's an active secondary market for the government bonds. There's practically no risk because governments are not expected to go bankrupt. An example of government bond is a T-bill. So it is a short-term government obligation which is offered in denominations from 1,000 to 1 million, and it's good for rich people. They like to invest in the government investments, and also for companies, and also smaller investors can invest as low as $1,000 in it. So they don't pay interest, but they're sold at a discount, meaning you may buy for $90 and you will get back $100 after 3 months, for example. So that $10 is income and is taxed as income and not as a capital gain. So different types of bonds. We have Canada Saving Bonds. There are also the Canada Savings Bond, Canada Premium Bonds. So they are not transferable and they don't have any secondary market. So when you buy these bonds from the government of Canada, you cannot sell them in the open market. You have to give them back to the government. So there are provincial bonds, which are also known as installment or debentures or serial bonds. They are non-callable. Non-callable means the government cannot cancel them before maturity. Remember the bond which was 5 years? If the government says after 2 years, we are canceling your bond and giving you back your money, that's not allowed in a non-callable bond. Canada Premium Bonds are purchased directly through most finance institutions. Canada Savings Bonds have actually been now discontinued recently, a few years ago. And municipal securities usually are non-callable, and the part of the bond that matures annually during the term of the bond. In municipal securities, it's called installment debenture. And then there are secured bonds. Companies, they pledge security to the bondholder. So secured bonds, usually companies, when they issue a bond, it's secured, meaning they have some assets which they will pledge for security. So if the company goes bankrupt, then the assets will be sold by the company and they will repay the principal. And then the debentures are non-secured bonds. So the debentures are non-secured, and the callable bonds, we said, are those which are issued by companies. And if they do call the bond, then they will usually give a little premium, a little bit extra more than what the client had bought it for. And the GICs are issued by also by banks. They are redeemable and non-redeemable, and investors have freedom of choice on term and frequency of interest payments. Other types of bonds are commercial paper and banker acceptance. So commercial paper are unsecured promissory notes. So these are issued by the companies directly through themselves or through a bank, and they usually have the period range from less than 3 months to a year, and they're usually selling in multiples of 1,000. Sometimes 25,000 is like minimum, and they're sold at a discount and they mature at the par value. So bank acceptance are also known as commercial draft. So it is issued by smaller companies. They will go to a bank and the bank will guarantee the bond. So they are similar to the commercial paper, only bank acceptance are for more smaller companies and commercial paper are for larger companies.